Ask a beginner trader what support and resistance are. Most will say something like, "It's simple. Just draw a few lines on the chart." And that's it. But here's the truth. This is exactly where most traders go wrong. They see support and resistance, but they don't truly understand it. So what happens? Price moves straight through the level they drew. Their stop gets hit, and the market runs in the opposite direction. Frustrating, right? In this video, you'll learn 10 powerful support and resistance insights used in real price action trading. These are concepts many traders either don't know at all or completely misunderstand. Once you understand these ideas, support and resistance will stop being random lines on a chart. Instead, they'll become one of the most powerful tools in your trading toolbox. So if you want to see how professional traders actually think about support and resistance, make sure you stick around until the end. Let's get started.
Tip 1. Support and resistance are zones, not lines. The biggest mistake traders make? They draw support and resistance as a perfect line, a thin line across the chart, and they expect price to react exactly at that level. But markets don't work like that. Price rarely respects a level with perfect precision. Most of the time, support and resistance are zones, not exact prices. Price might react slightly above the level or slightly below it, and that's completely normal. This is why experienced traders often draw zones instead of lines, because markets don't move based on a single number. They move based on liquidity. So remember this rule. Support is a price area. Resistance is a price area, not a razor-thin line on your chart. And if price briefly moves inside that zone, it doesn't automatically mean the level failed.
Tip 2. The more a level is tested, the weaker it becomes. Here's something many traders believe, but it's often wrong. They think the more times price touches a level, the stronger it becomes. Sounds logical, but in many cases, the opposite is true. Every time price touches a level, some of the orders there get absorbed. Imagine a support level with a large number of buy orders. The first time price reaches it, a big portion of those orders gets filled. The second time, fewer orders remain. The third time, even fewer. So with every test, the level becomes weaker, and the probability of a breakout increases.
3. The first touch is usually the strongest. One of the most important principles in price action is simple. The first touch matters the most. Why? Because when price reaches a level for the first time, most of the resting orders are still sitting there. That's why the reaction is often strong and immediate. But on later touches, many of those orders have already been filled, which usually leads to smaller reactions. This is why many professional traders focus heavily on first touches. Tip 4. Higher time frame levels are stronger. Not all support and resistance levels are equal. Levels that form on higher time frames are usually stronger. For example, daily levels and weekly levels. Why do these levels matter more? Because more traders see them. Retail traders, institutional traders, funds, even trading algorithms. When more participants watch the same level, more orders build up around it. That's why experienced traders often start their analysis on higher time frames first. Then they move down to lower time frames for precise entries. But here's something many traders overlook, and it's extremely important. A large number of support and resistance breakouts are actually traps. In a moment, I'll show you how to recognize fake breakouts, and understanding this can save you from a lot of unnecessary losses.
Tip 5. A real breakout usually requires a candle close. Here's a very common mistake. Price briefly moves beyond a level, and traders instantly assume the level is broken. But many times, that move is just a wick. In price action trading, a breakout is usually considered valid only when the candle closes beyond the level. Not just touching it, not just wicking through it. What really matters is where the candle closes. Tip 6.
Broken support often turns into resistance. This is one of the most important concepts in technical analysis. When a support level breaks to the downside, it often becomes resistance when price pulls back. And the opposite is also true. When resistance breaks, it often becomes support during the pullback. This concept is called role reversal, and it's a core principle in price action trading.
Tip 7. Location matters more than the level. Not every level on a chart is equally important. Some levels barely matter, but others can be extremely powerful. For example, major market highs and major market lows, areas where strong impulsive moves began, zones where heavy trading activity previously occurred. Levels in these locations tend to create much stronger reactions. Why? Because that's where significant liquidity usually exists. Tip 8. Fake breakouts happen all the time. Markets are rarely straightforward. Sometimes price moves slightly beyond a level. What happens next? Stop losses get triggered. Traders assume a breakout has occurred, and they jump into the trade. Then suddenly, price reverses. This is called a fake breakout, and many traders get trapped by it. Learning to recognize fake breakouts is one of the keys to surviving in the markets. Tip 9. Support and resistance are liquidity zones. Here's a crucial truth about markets. What actually moves price is liquidity. Key market levels often exist where stop losses are clustered, large orders are waiting, heavy trading activity happened before. Because of this, price is naturally drawn toward those areas. In other words, support and resistance levels often represent liquidity zones. Tip 10. The best trades often come after the pullback. One of the most common strategies used by professional traders works like this. First, a key level breaks. Second, price pulls back to that same level. Third, the real move begins. Entering during the pullback often provides lower risk, better risk to reward opportunities. That's why many experienced traders prefer trading the retest instead of chasing the breakout. Quick recap. Let's quickly summarize. Support and resistance are usually zones, not exact lines. The more times a level gets tested, the weaker it often becomes. The first touch usually creates the strongest reaction. Higher timeframe levels carry more weight. Real breakouts often require a candle close beyond a level. Broken support can turn into resistance. Broken resistance can turn into support. The location of a level often matters more than the level itself. Fake breakouts happen all the time. And finally, some of the best trading opportunities appear during pullbacks to broken levels. Once you truly understand these ideas, charts start to look much clearer. If you found this video helpful, make sure to hit the like button. And if you want to learn more about price action, smart money concepts, and professional trading strategies, consider subscribing to the channel. In upcoming videos, we'll cover topics like 10 trendline tips every trader needs to know. So if you don't want to miss them, make sure to subscribe and turn on notifications. Thanks for watching, and I'll see you in the next one.